Hello, everyone, and welcome to the April Market Compass. There have certainly been no shortage of headlines to digest, and the market and trade narrative have been shifting rapidly. In today's Compass, we'll discuss the near term and then zoom out to provide some perspective on long-term investing. First, I'll walk through our views on the recent tariff update and implications, and then take a step back to talk more broadly about some long-term principles of investing. These are particularly important to remember as we go through periods of market volatility and uncertainty. So where do we stand on tariffs and trade? As of mid-April, the White House announced a 90-day reprieve on tariffs, moving tariffs to 10% on most partners, while hiking tariffs on Chinese imports to around 125%. Now, keep in mind, this pause does not apply to sector-specific tariffs, including autos and steel and aluminum. So what does this mean for markets and investors? Despite the tariff reprieve, tariff rates are still set to move substantially higher in the U.S. Given the 10% baseline tariff, combined with the 125% tariff on our third largest trading partner, China, and sector tariffs, this still leaves average U.S. tariff rates close to 20%, up from about 2% pre-Liberation Day. However, despite the rise in tariff rates, the administration is indicating that negotiations will continue across multiple economies, potentially including China. So while uncertainty remains, perhaps the worst-case scenario on tariffs is off the table. Nonetheless, higher tariff rates do act as a tax on consumers across many goods. We would expect prices to rise and economic growth to soften in the months ahead. According to a 2018 Fed model, the higher tariff rates could impact GDP growth by 2.4 percentage points and inflation by 1.4 percentage points. We'll also be hearing from corporations during earnings season whether tariffs have impacted their ability to plan, spend, make deals, or hire. Now, I've mentioned some of the uncertainty that comes with the escalation in tariffs, but are there any mitigating factors? Well, I'll highlight three potential ones. Number one, economic growth in the U.S. started from a position of strength. This is a much better position to be in versus had tariffs come when the economy was already weakening. In fact, Q4 GDP in the U.S. was a healthy 2.5%, and we know the labor market remains relatively healthy, and even inflation has been contained over the last few months. Number two, the Fed has scope to cut interest rates this year. Now, while the Federal Reserve will be mindful of higher prices and inflation that come from tariffs, they will also be watching economic growth and the labor market closely. If there are signs of deterioration, we believe that the Fed will be poised to cut rates, perhaps 2 to 3 times this year. Now, this is more likely to happen in the back half of the year when the impact from the tariffs becomes more clear. And number three, tariff revenue may be used to support pro-growth policies like tax reform. Now, while the focus of the administration has been tariffs thus far, we may start to hear more around pro-growth policies like tax reform and deregulation. If the administration can extend the 2017 tax cuts, which expire at the end of this year, this may provide some fiscal support to the economy as well. Also, the shift in narrative from tariffs to tax cuts and deregulation may be supportive of market sentiment as well. Let's zoom out and remind investors of an important tenet of long-term investing, especially as we navigate uncertainty and volatility. And that is, time in the market is generally a better approach than trying to time yourself in and out of the market. Now, as markets move lower and pull back, some investors may be feeling understandably nervous and may want to sell assets. Now, keep in mind, if you do sell, you then have two decisions to make: when to sell and when to buy back in. And it is, of course, notoriously difficult to time market tops or bottoms. Now, another way of looking at this is the missing the best days chart. As seen here, this chart shows that if an investor had bought $10,000 of the S&P 500 30 years ago and just held it without buying or selling, their portfolio value would be about $224,000. However, if they had missed just the 10 best days in the market over that 30-year period, their portfolio value gets cut by more than half. and it gets worse the more best days that are missed. Now, our analysis shows that many of the best days in the market occur during periods of crisis, like the pandemic, the financial crisis, or even now during tariff uncertainty, where we recently saw a historic market rally after the pause in tariffs was announced. So, while some may be tempted to sell investments or exit during the market volatility, remember that you also risk missing some of these best days that could have a meaningful impact on your long-term returns. Now, with that, thank you for joining me today as we discussed both the near-term implications of tariffs and some thoughts on long-term investing as well. We look forward to seeing you back here next month for the Market Compass.